Welcome to the Explainer. Listen, today we're going to crack the code on the SAP FICO interview. We're going way beyond the textbook to give you the practical, real-world answers that hiring managers are actually looking for. Let's get you ready for that job offer.
All right, let's just dive right in. Picture this. You're in the interview, and the hiring manager leans forward and asks you this very question. It's one of those heart-stopping moments that can make or break the whole thing. But don't you worry, we're going to build that perfect, confident answer together, piece by piece.
So here's the game plan. First, we're going to nail down the two most fundamental cycles, how a company buys stuff and how it sells stuff. Then we'll get into the absolute non-negotiables of document control and how to pull the reports that matter. And it all leads up to the grand finale, the three-way match, which is the secret weapon to answering that opening question like a pro.
Okay, first up, procure to pay, or P2P as you'll always hear it. For any company that actually makes a physical product, this cycle is its absolute lifeblood. And this isn't just for buying nuts and bolts, it's the exact same process you'd use to buy a massive piece of plant machinery, which then kicks off the whole asset accounting process.
Here it is, the entire P2P flow, laid out in 5 clear steps, from someone in the factory needing something, all the way to paying the bill. Now, those codes you see in the parentheses, those are the T codes. Think of them like keyboard shortcuts or direct commands for SAP. Knowing them shows you're not a rookie. It shows you speak the language. Of course, none of this can even begin until the vendor is set up in the system as a business partner, using T-code BEP.
Now this is where the financial magic really begins, at the goods receipt with T-code MIGO. The second the truck unloads the materials at your factory, something huge happens on your balance sheet. Boom! Your company owns a new asset. And the critical thing to get here is the timing. This happens before you've even seen the vendor's invoice.
All right, let's pop the hood and see what's happening with the accounting entry. The debit to inventory? Yeah, that makes total sense. Our assets just went up. But look at the credit. It's not going to the vendor. It's going to this special holding account, the goods receipt/invoice receipt, or GR/IR, clearing account. And this, my friends, is where SAP gets really, really clever.
And right on cue, that leads us to a classic, and I mean classic, interview question. A sharp hiring manager will want to know if you understand the why behind the system. So why this extra step? Why not just credit the vendor directly?
Here's the best way to explain it. Think of the GR/IR account as a temporary bridge. It's a placeholder liability. It basically says, hey, we know we have an obligation because we're holding their goods, but it smartly separates that from the legal liability, which only gets created when the actual invoice arrives. This little distinction is what keeps the company's books accurate in real time.
And here we are, crossing to the other side of that bridge. The invoice finally lands on your desk, you process it with Miro, and watch what happens. We debit the GRIR account, poof, it's zeroed out. We book our input tax credit, and only now do we finally credit the vendor, creating the official accounts payable. See that? A perfect, clean, closed loop.
All right, let's flip the coin. We've talked all about spending money, so now let's talk about the fun part, making it. This is the order-to-cash cycle, or O2C. It's all about how the company gets paid.
And you'll probably notice the process is pretty much a mirror image of the purchasing one. It kicks off with a customer's order, we ship the goods, send them an invoice, and finally, hopefully, we get the cash. And again, knowing these T-codes is non-negotiable. And yep, you guessed it, the customer has to be set up as a business partner first before you can sell them a single thing.
So remember MIGO from when we received goods? We'll say hello to its twin on the sales side, PGI, or post-goods issue. This happens the moment the goods leave our warehouse. The instant that truck pulls away, SAP automatically posts a financial entry in the background. We debit cost of goods sold and we credit inventory. This is beautiful accounting in action. It's the matching principle live, recognizing the cost right alongside the revenue we're about to make. Then, using T-code VF01, you create the billing document, which is the official sales invoice. And this is the entry that everyone loves to see. You debit the customer's account, which creates an accounts receivable, and you finally get to credit sales revenue. This is the moment that sale officially hits the company's profit and loss statement. Okay, so posting entries is great, but let's be real. Humans make mistakes. What happens then? Well, this brings us to an absolutely fundamental concept in SAP, and one that interviewers love to test you on: document integrity.
You can't just hit the delete key and pretend it never happened.
Now, before an entry is permanent, SAP gives you a couple of safety nets. A held document is like a draft saved only on your own computer. But a parked document, that's more formal. It gets a real document number, it's saved centrally, but, and this is the key part, it does not hit the main financial accounts yet. This is the engine that drives the maker-checker principle, where one person can make an entry and park it, and a manager has to check it before it's posted.
So if you remember just one thing for your interview, make it this. In SAP, you never, ever, ever delete a posted financial document. It is simply not possible. Instead, you use T-code FB08 to post a reversal. What this does is create a brand new document that is the exact opposite of the mistaken one, canceling it out perfectly while leaving a crystal clear audit trail of both the error and the fix.
So we've spent all this time getting data into SAP correctly. Now let's talk about getting data out. Because all that meticulous entry really pays off when you get that high-pressure request from your boss, like, the bank needs the monthly stock statement and they need it now.
This is a super practical question you might get. They're not testing you on some abstract theory. They want to know if you can actually perform a critical task when the pressure is on. Your answer here needs to be confident and precise.
Your answer starts with inventory, and the T code is MB5B. You say it just like that. This report is so powerful because it's basically a time machine for your inventory. You can see the exact stock position and value on any specific date in the past. For that month-end bank statement, this is the precision tool for the job.
Next, for receivables, you run FBL5N. But here's the pro move, the thing that will make you stand out. You have to mention that you filter this report to exclude any customers who haven't paid in over 90 days. Why? Because banks won't lend against old, potentially bad debt. Saying this shows you don't just know how to run a report, you understand the business logic behind it.
And now we've arrived at the final piece of the puzzle. This is what ties everything together and gives you the perfect airtight answer to that very first interview question we started with. Let's talk about the single most important control in the entire procure-to-pay cycle.
It's called the three-way match, and it's a simple but incredibly powerful concept. Before you pay a single penny, you have to make sure 3 documents are in perfect alignment. 1. The purchase order. What did we agree to pay? 2. The goods receipt. What did we actually get? And 3. The vendor invoice. What are they actually billing us for?
And that brings us to your perfect mic drop answer. When the interviewer asks you how you verify an invoice, this is what you say. It's concise, it's confident, it uses the right T-code, Miro, and it shows you're not just a data entry clerk. You have a commercial, risk-aware mindset. You're showing them you are a guardian of the company's cash.
So, when you boil it all down, the key takeaway is this. Mastering SAP FICO is so much more than memorizing T-codes. It's about understanding the why behind the system's logic. It's about using these tools not just to record history, but to actively protect the company's future. And when you can articulate that, you're not just an accountant, you're a business partner.